So Cathie Wood's ARK Invest started buying the dip in Tesla shares after months of selling. Well, this has indeed raised eyebrows amongst investors who are left wondering what the Tesla bull is planning. We're going to find out the genesis of the latest purchases by Cathie Wood's ARK Invest. The investment company bought 33,482 Tesla shares on January 27th, worth nearly $28 million across its flagship ARK Innovation ETF and the ARK Next Generation Internet ETF funds. On February 1st, the popular money managing firm also bought 42,124 shares, which are estimated to be worth $39.45 million. This was ARK Invest's second buy in the Elon Musk-led company's stock this year after months of continuous profit booking when Tesla shares traded above $1,000. ARK Invest counts Tesla among its biggest bets. Well, Tesla shares were under pressure despite it reporting an earnings beat on January 27th. Shares of Tesla tumbled 11% to their lowest close in 3 months, after the company delayed releasing new vehicles until next year because of supply chain disruptions it said could last through this year. So what's in the pipeline for Tesla? Maybe this could explain ARK Invest's sudden interest in Tesla stock again. Now, Tesla's CEO Elon Musk told a quarterly conference call that Tesla would not launch new models like Cybertruck this year because it would dent volume growth in the face of supply chain headwinds that would be alleviated only next year. He said Tesla would focus on ramping up the volume of existing models in 2022 by more than 50% rather than launching new ones. Elon also said Tesla is not working on a $25,000 electric car yet. So there's a high chance that these comments had an impact on the Tesla stock price following the 2021 fourth quarter earnings report. And while other investors were seen selling off their shares, ARK Invest was piling on their stash. The fund began trimming its holdings in the electric vehicle maker in August 2021. Tesla is still ARK Innovation's top holding, but its weight in the ETF has dropped compared to where it was last year. Wood said in September 2021 that she has a 5-year price target of $3,000 for the stock. So it could be that she sees an opportunity in the recent dip. Maybe the plan is to pile up on Tesla stock, then sell off when Tesla manages to reach the $3,000 price target. We can't tell for sure, but if it does, then that's good news for Tesla stock investors. Tesla bulls continue to pile into the stock in the hopes that Tesla will revolutionize the auto industry, energy, software, transportation, insurance, and more. Tesla's record vehicle deliveries were a major factor in stock performance in 2021. Selling just under 1 million cars in 2021 sounds great, and it was not a small feat. Tesla stock was up more than 10% year to date when it released better than expected fourth quarter and full year production and delivery numbers in early January. But the electric car stock went down nearly 20% year to date after reporting fourth quarter and full year earnings on January 26th. Well, that indeed sparked a massive sell-off, but for ARK Invest, it's a whole different scenario as they are buying the dip. A lot of people don't know this, but industry-leading companies can see their share prices fall after excellent earnings reports for several factors within and outside their control. For starters, investors can drive up the stock price, leading to earnings. In this case, Tesla's stock price, along with the broader market, was falling in the day leading up to the report. Another reason for a post-earnings decline could be weak guidance, which we'll get into in a bit. But the most concerning reason, and something we've been seeing with a lot of top companies so far this earnings season, is when Wall Street begins reevaluating a company. Known as multiple contraction, stock prices can tumble if investors are less willing to pay a premium price for a stock relative to its sales or earnings. The opposite of a multiple contraction, known as a multiple expansion, helped the S&P 500 double between 2019 and the end of 2021. The issue with a raging bull market is that it can get derailed in a hurry if the macro factors change. And with the Federal Reserve raising interest rates in March and likely 3 or 4 times this year, debt will become more expensive, which hurts growth stocks. Inflation dilutes the purchasing power of a dollar, which is a problem for unprofitable companies that are valued on future earnings. These headwinds, paired with ongoing supply chain concerns, a tight labor market, and a U.S. stock market that may have gotten ahead of itself, are all reasons for a correction. Yet Tesla isn't the debt-dependent company it used to be. It's now consistently profitable and free cash flow positive, meaning that its business generates more cash than it needs to run its operations. This dynamic is a stark contrast to the production hell days when Tesla was diluting its stock or borrowing money to make ends meet. In fact, Tesla ended 2021 with a debt of just $1.4 billion after paying down $1.5 billion in debt. Tesla has one of the highest operating margins in the auto industry and is on track to grow its global manufacturing footprint once it opens factories in Germany and Texas. It's worth mentioning that Tesla believes the 50% production growth goal is possible using capacity solely from its California and China factories. The company expects production volume to increase by 50% in 2022 compared to 2021. Tesla cited ongoing supply chain constraints as an issue that could impact its performance in 2022. Along with broader market headwinds, it wouldn't be surprising to see Tesla stock continue to be volatile and fall further from here. But the long-term thesis for Tesla is brighter than ever. Tesla is a polished company with a leading position in the electric vehicle industry. There are plenty of other attractive buys in the EV space, but Tesla remains a worthy addition to a diversified basket of EV stocks. Dan Levy, an analyst at Credit Suisse, upgraded Tesla stock to outperform from neutral in a note stating that the pullback in Tesla's stock price creates an attractive entry point. Levy acknowledged the recent downturn in growth stocks since the start of the year and said that Tesla had been disproportionately hurt by it. But he made the case that the stock will recover from its current slump. With less question around demand and much more question around the supply of EVs, Tesla should be a key beneficiary as it has a product lead and has taken the most holistic approach in EV supply. Not only does Tesla not have to tackle the challenges, but Tesla also has leads in vertical integration, software, product simplicity, and capital availability. Well, Tesla recently reported earnings that surpassed analyst expectations. It had earnings per share of $2.54 versus analyst estimates of $2.36, and it had record profits. The company delivered 936,000 electric vehicles last year, which was a new high. Based on its latest earnings report, Tesla also has the best operating margin among electric vehicle manufacturers. Strong margins are critical not only for earnings per share, but also as people expect Tesla to eventually use its margin strength plus software standardization to spur volume growth. Up until now, Tesla margins have largely been a function of auto hardware sales with some modest benefits of software, specifically the full self-drive features. However, as Tesla releases more FSD features and unlocks more deferred revenue, which likely flows through at 100% contribution margin, Tesla should see incremental margin benefit. Furthermore, Tesla also expanded its operations to include more manufacturing facilities in Austin and Berlin. The additions should boost the company's output above its current goal of increasing output by 50% each year. So despite the recent sell-off and persistent supply chain challenges, Tesla will still find a way to raise delivery numbers and revenue in 2022. The recent dip should be seen as an opportunity to add the stock into your investment portfolio. For ARK Invest, this has been the perfect opportunity to double down on Tesla stock, and investors should probably follow suit. But that's their decision to make. Well, we've come to the end of our session today. Remember to hit the like, subscribe, and share buttons. See you next time.